Have hedge funds killed SPAC investing? Are hedge funds to blame for the decline in SPAC stock prices? For those of you which don't know, a SPAC stands for Special Purpose Acquisition Company. You can basically think of this as a shortcut for a private company to go public instead of doing a traditional IPO or initial public offering. Now, there was a whole SPAC mania back in 2020, and many of these stocks were popping by 40, 50, 60% in a single day. And this was euphoria, this was exciting, this was incredible. And many hedge funds were actually trading these stocks rapidly, in addition to many retail investors, including many of you guys on this channel. And after investigating many of these companies, it seems as if there's really been a differentiation between what retail investors thought about SPAC companies and what hedge funds actually had planned for these companies. Because as far as I know, a lot of retail investors saw these incredible companies like Joby Aviation and many, many more as great long-term investments, great long-term plays on a new exciting technology. But the hedge funds, they had a different idea. The hedge funds purely saw these as a trade, and many of them actually got out pre-merger. Now, should the SEC have actually done something about this in order to stop this happening with these SPAC stocks and actually communicated this better to the retail investor? Probably so. So in this video, I'm going to dive into the details about what the hedge funds actually did, why this has caused many of these SPAC stocks to decline, and what we can do about it as investors. So be sure to stick around to the end of this video, guys, and I think you'll like what I've got for you, and you'll find this incredibly valuable to just really get down to the mechanics and the bowels of what these hedge funds actually do, because really they're playing completely different rules. They're playing with vast sums of money, and really I hate being that guy who's the controversial person against hedge funds, against the hedgies. But after seeing this and reading these details, it just seems like really it's not a fair playing field for the retail investor. So let's dive into those details, and we're going to find out a lot more. If you guys haven't joined the investing family yet, and you do like stock picks, investing tips, feel free by hitting that subscribe button, turning that notification bell on. If you do appreciate the raw honesty, transparency in this video, feel free to give it a big thumbs up. That helps out tremendously with the channel. With that being said, let's dive in. Okay, so the first article I want to bring to your attention, guys: hedge funds love SPACs, but you should watch out. Retail investors need to understand the role of hedge funds play in seeding SPACs. The two groups' interests aren't always aligned, and this is really the risk. So free lunches don't last long in finance, but hedge funds have identified a temporary exception to that rule: the Special Purpose Acquisition Company, or SPAC. Now, this basically was a free lunch. There was major gains in the market within 1 to 2 days. Most investors are happy with 10% returns over a year. These SPACs were going up by 50% in a single day. If that's not free lunch, I don't know what is. Now, the way hedge funds have operated is hedge funds have actually been providing bridge loans that have enabled a host of famous names from the world of business, finance, and politics to launch their own SPACs this year. So you may have heard of multiple celebrity SPACs being launched. The funds are often arbitrages, though with no intention of remaining investors once a SPAC has found a merger target. Now, retail investors and institutional investors who hold SPACs as long-term investments once a deal is struck haven't always done as well. Now, this is where the differentiation comes in, because many of these hedge funds are literally just been trading these SPACs, and that was their plan from day one before or even merger has actually been complete. Whereas many retail investors saw these as great long-term investments. Yes, they were speculative, but still great long-term investments. So there's really a lot of disclosure issues here and communication issues with regards to how these SPACs were communicated to the public. Okay, according to Bloomberg right here, hedge fund profits come partly at these other shareholders' expense. That's you guys, the retail investor. Now, that's all the more reason for retail investors to get to grips with how SPACs operate, and for the finance industry to consider overhauling the way these complicated, costly cash shells are structured, because they are incredibly complicated. I remember explaining them on this channel multiple times, diving into the details, trying to value these companies, and they're incredibly complicated, and that just adds extra risk, because if you can't see the problems in these devices, then that adds extra risk in the market. Now, interestingly enough, just 10 hedge funds still own more than a quarter of all SPAC securities. This means these 10 hedge funds can effectively move the entire SPAC market. And the top 75 investment managers hold almost 70% of all SPAC stocks. So as you can see here, these hedge funds are among the biggest investors in SPACs. We've got Millennial Management, we've got Magnetar Financial, we've got Polar Asset Management, Periscope Capital, Bluecrest Capital. Okay, so how did the hedge funds trade these SPACs and what was their plan from day one? Diving in right here, we can see the investors managed to get a majority of these SPACs at the $10 base price, which was the floor price, which was equal to the cash which was inside these SPAC companies. So the investors pay $10 for one share and up to one warrant in an IPO. They call it an IPO, but it's really a SPAC merger announcement. So cash is held in a trust account and invested in short-term treasury bills. Now, after a few weeks, shares and warrants can be traded separately. So the hedge funds can buy shares if they dip below the cash value in the trust, and warrants can be flipped for a quick profit or retained in case value rises. Now, this is where things get interesting. So when a SPAC deal was announced, okay, this company is merging with this SPAC shell company, for example, Joby Aviation is merging with RTP Reinvent Technologies as an example. So the deal was announced, and as many of you guys know, the shares popped massively, but this is where it gets interesting. So for example, if we dive in here, deal gets announced, Joby Aviation trading around $10, the floor price, deal gets announced, the stock pops by 30%. Another example here, Atlas Crest Investment Corp. Deal gets announced in February 2021. Stock pops by 51%. So incredible returns within literally just a couple of days. And literally many retail investors think, okay, this is going to the moon, or at least it should continue on maybe more of a steady state after the merger's been announced, which is a positive sign. But then this is where the hedge funds decided to sell. So basically they did a big sell-off straight after, and this left many investors, many retail investors holding the bag on many of these SPAC companies. Now on this channel, I always stated investing in SPACs is incredibly speculative, and I will personally limit my portfolio to less than 5 to 10% in these SPAC stocks just because of the speculation. But now the truth is out about these major hedge funds and how they've been manipulating the market. That really doesn't help with the whole investing thesis for many of these companies. Because hopping in right here, guys, again, so the shares pop, the hedge funds sell, they crash down, retail investors, the majority, are left holding the bag. Now, I know many retail investors also are trading these SPACs. I personally was trading these SPACs also, but I was also holding a lot of shares in these SPACs as long-term investments, as I know many of you guys were. Now, the shares dip below $10. Hedge funds can redeem and still keep the warrants. Now, this is where it gets interesting again. So, for example, here's Joby Aviation. Recently, again in August, the stock popped by 34%. Now, that would have been a great time to take a bit of profit there. But then, again, the hedge funds sold out again, down 30%. Now, this is where it gets interesting. So, it's trading now $9.29 per share, which is a great buying opportunity, to be honest, for a stock like this. But it's below $10. Now, if this was pre-merger, what the hedge fund could do was actually claim back the difference between the below $10 and the $10 as a redemption. And this basically is a money-back guarantee for hedge funds. If the stock drops below $10, you can claim your money back. If it goes up, you can keep the upside potential. And this was the free lunch that these hedge funds were taking advantage of, but many of them at the expense of retail investors. So most arbitrage funds exit before the deal closes, as redemption right then disappears. So after the merger is complete, the redemption right, if it drops below $10, disappears. It's just pre-merger, these hedge funds can actually get this money back guarantee. So after the merger is closed, it tends to be held then by more long-term investors, and that's probably the best time to invest in many of these companies. But many investors, retail investors and hedge funds, were getting in early because these stocks were popping up massively and people didn't want to miss out on these deals. But there was really a SPAC mania going on. It did turn into a bubble. So how many of these hedge funds have actually been getting a refund on many of these SPAC stocks? Well, hopping in right here, we can see cashing out. This is according to Bloomberg. With blank check firms trading below $10, redemption rates are soaring. So as you can see, in June, July, August redemption rates went sky high as many of these hedge funds were actually taking their money back. And as you can see here, there's many acquisition companies here, and 95%, for example, has been redeemed in this acquisition company here. Many of these I don't know, and many of these I didn't invest into in this channel. We did invest on this channel potentially into Reinvent Technologies partner Z Hippo Insurance, which I still think's fantastic company. But when the stock price dropped below $10, many of these hedge funds redeemed their money, got their money back out of this investment vehicle, and that actually affected the stock price even more and will leave the stock price depressed in many of these SPAC companies. So that's just what I want to bring to your attention in this video, guys. It's clear that many of these SPAC stocks, yes, they're speculative. Yes, many of them are what's called story stocks. They have this future technology. They really want to change the world. Some of these companies, some of them will, majority of them won't. There was an abundance of these SPAC stocks. Majority of them, probably 90% of them, were rubbish. On this channel, I tried to cover the very best, which were great long-term investments. But the reason the stocks seem to have been so volatile and they seem to have been so crazy is the fact that these hedge funds have literally just been cashing out, trading, moving vast sums of money and taking advantage of the retail investor. Now, I think this is a complete travesty, but this is just what we've got to deal with in the market. We've got to judge our risk. And I personally, for you guys, I'll be tracking hedge fund trades a lot closer on this channel. And I'm actually currently working on a software at the moment to track hedge fund trades even closer for you guys. So if you guys want live updates on when these hedge funds are buying, selling, so you don't get caught out in the market, you don't get caught holding the bag, you'll know when I'm exiting my position like I did, for example, February 2021. I saw the hedge funds selling Tesla stock, even Cathie Wood was trimming Tesla stock, and I trimmed my Tesla stock, and then after the Tesla dropped by like 30%. So those are great examples of when knowing this real-time information from what these big whales in the market are doing can be really beneficial to you guys in the stock market. And to be honest, it's a no-brainer. You need to know this information, or you can just be left holding the bag in many of these companies which you think are great investments. So if you guys do want to be a part of it, get these live updates and also get access to the software when it's online. In the meantime, you can join our VIP membership group. That's the second link in the description below. It's basically like the price of a coffee every single month. You get access to my live buys, sells, my entire six-figure portfolio, and much, much more. Also, you can check out my valuation points for multiple different stocks. Check out that first link in the description below for our Ultimate Investing Strategy course. Find out more about that. That's not some $1,000 course, $2,000 course, guys. It's like $20 a month. You get access to all that information I've just mentioned, plus 12 units of investing courses and over 10 to 15 extra bonus videos for you guys to help you guys in the market to learn the greatest investing skills in order to be successful and become financially free in the market. So all that, guys, first link in the description below, and I'll see you guys on the other side. I wish you guys all have an incredible day. Be sure to subscribe if you haven't already. And yeah, I wish you guys incredible luck in the market. I hope you're all doing well. I hope you're all healthy during the crazy times that we've been experiencing in the world recently. And I'll see you guys in my next video. Invest safe.